Okay, everybody, welcome to Finance 444. Long time no see for most all of you. Sorry that you have to put up with me for another mod. For those of you who were loathing the last class, this class will be related as far as the topic material. But as far as the tests, as far as having an ebook, I think it's a much different class as far as the formatting. Last class, if you were with me in Finance 443, we didn't have an ebook. We were looking at Investopedia for the material. And as far as I'm concerned, there was too much material. It made those tests very, very difficult. This course goes back to how I think courses should be structured from the college, which is a situation where you have two chapters in an e-text, and we'll go over some of the slides tonight for those two chapters, chapters 12 and 13 specifically for this week. And the test is very specifically testing over just those two chapters and does a good job testing to the reading. So should be much better from a test-taking standpoint than the last class was. But many of you, even as bad as those tests were in the last class, did very well, and I congratulate you if you scored well in that last class. It was a more difficult class because of those tests. As far as discussion boards, assignments, checkpoints, that standard procedure here in this course and usually in all the courses that I teach. Tonight, we'll make very quick work of the minimum expectations because I believe that most of you were in my course or in my mod last month. So we'll get through that very quickly. Then we'll cover chapter 12 and 13, give you a heads up on the assignment and discussion board, which some of you have a head start on already. And then spend a good chunk of time at the end, as we always do in every single session, giving you the topics that you'll specifically want to look out for as you read the material from chapters 12 and 13 this week in the text that will be on the test. Okay, so 25 points, 25 questions on the test this week, all multiple choice, no matching. That's for you, Michelle. No definition matching on the test this week, so you'll appreciate that. And so you'll be in good shape, but some true false and then mostly multiple choice. So we'll give you a heads up on the topics you need to know. But like I say, because it's just from chapters 12 and 13 and we're actually using a normal textbook as opposed to a site that's getting people ready for a test that's just vastly broad beyond the scope of what we'd want to do in a normal class, this should be much easier because 443, like I say, there was just so much material when we get to those tests based on what's at the Investopedia site. Okay, so here at the beginning, I always go over briefly expectations. We can even go a little bit faster than we did last time, but the bottom line is checkpoints and discussion boards are the easiest way to get basic points in a class like this. Find a time every day where you can go in and do the checkpoint. It's the only part of our work that we do in a course like this that you cannot do late, right? So once the checkpoint closes, we can't go back and do it again. So it does require us to have a sustained effort, that's consistent throughout the mod. I would find a time every day that I could do it. When I did some online courses a few years back, checkpoints were the easiest way for me to get some extra credit. You can get up to a half a letter grade worth of extra credit based on doing the checkpoints every day and being consistent with that. So just do it. Find a quick time every day, make it consistent, make it a habit, and make sure and get those done. As far as the discussion boards, I am a little bit of a stickler on making sure that the instructions are followed. You'll find that. Just follow the instructions. You need 2 to 3 substantive paragraphs for the main post. Make sure it's in by Wednesday at midnight. Make sure you've got at least a reference or 2 with that post, and make sure you're answering exactly what the instructions are calling for in that main post. And then other than that, just make sure you have 2 days of participation on the board, okay? You got to have more than 1 day of participation. And those 2 other response posts need to be fairly thoughtful. Don't just make them 1 or 2 lines. And then just make sure you've got them all in by Saturday at midnight, and you'll get full credit. I think you'll find that I try to give you full credit. I'm not going to get nitpicky about formatting. I'm not going to get nitpicky about misspelled words or anything like that. I'm not going to dock you for any of those things. But I will not give you full credit if you just don't follow the instructions. So just be very careful about the instructions on the coursework, and you'll be in great shape. I'll look for reasons to give you full points. I will not look for reasons to dock you, okay? So discussion boards, checkpoints, pretty straightforward. As far as the assignments in this class, once again, the assignments are worth just over a third of your grade. Very difficult to pass a class like this if we don't get all our assignments in. And I will accept all the assignments, even late work up until the final week 4 Saturday at midnight. So you can turn them in late, however, you don't get full credit. And I think what a few of you found in the last course is that you were really trying to get points from wherever you could because you, had a few assessments that didn't go as well. And turning in the assignments late didn't give you enough points to get the grade that you were looking for. So if you want a good grade in the class, an easy way to accomplish that is to do things on time and to follow the instructions carefully. If you follow instructions carefully and put things in on time, you should get an A in the class. And I hope that we have a lot of you that get an A in the class. I think some of the people in the session tonight got an A. I'm not going to point you out and make other people feel bad, but I think we've got it. We've got some A's here in the session. So if any of you all who are listening to this maybe after the fact have any questions about how to get an A in one of the courses that I teach, you can go ahead and email one of the folks that are here tonight, and I think they could probably help you with that. Hope you're willing to give feedback, those of you who are on tonight. All right, good to hear that, Michelle. Yeah, the matching terms, it makes it kind of difficult when they're similar, but it also can make it easy if they're the same section, right? Because then you only study that section, and if you basically understand that section, then you're in good shape. Like I say, this mod, I haven't looked at all the tests, but as far as this week's mod is concerned, or this week's test is concerned, we don't have any matching problems. As far as the test this week, as I mentioned already, you got 25 questions, true, false, and multiple choice mix. Should be pretty straightforward. Like I say, straight out of chapters 12 and 13. The best way that I know to help people prepare for the test is to jot down a few topic notes from tonight during the session, or when you're listening to this as a recording, and then take those topics with you, just a page of them, when you're reading the chapters. And if you'll just look through that list of topics before you read through the chapters, when you're reading, you'll be able to pick out, your mind consciously or even subconsciously will pick out those topics that you know are going to be on the test and pay special attention to those, to the point where you'll be able to internalize them before you get to the test and make the test much, much easier. Okay? So that's what I would do to prepare for the test. The course, as far as I'm aware, is pretty straightforward. Test 1 is just a couple chapters. Test 2 is like a midterm. Test 3 is the normal couple chapters again. And then Test 4 is your final exam that week where you don't have anything else but that final exam. And then, of course, you've got the course survey and a new little test that they put in for 15 points. It's a really easy way to get 15 points, but basically they want just some positives from the course to give back to the school. Okay? So pretty easy if just for those 15 points, of course. Any questions about minimum expectations for a course like this? Any questions or concerns about the different things that we're going to be doing in this course? The assignment this week on exchange traded funds. Let's see. Yes, the assignment this week is based on exchange traded funds. It's number 8. It's on page 532. In fact, let's talk about that real quick, Michelle, because the instructions, I don't think they give you the page number, and it's not the easiest thing to find. It is at the end of the chapter, of course, but it's number 8, and that's on page 532 at the end of that chapter. And basically what it's asking us to do this week is to talk about ETFs, which are exchange traded funds, that you'll be learning more about from the chapter and tonight during the session. And ETFs are the most popular new investment product that the public can invest in. Okay, so over the last 10 years, ETFs have really come onto the scene as far as an investment strategy and product. They become more popular than mutual funds as far as new additions. They're still about a tenth of the total balances of mutual funds, but in part that's because most of us have mutual funds offered in our 401ks and IRAs, and many of us don't have ETFs offered in our 401ks and IRAs yet. But those are coming. So over the next few years, in the average 401k, ETFs will be offered as well. So it's a great opportunity in a course like this to kind of explore what those are. and so you'll know what they are when they come. If you have a job that offers a 401k, which you probably will at some point over your career. So the assignment this week will ask for 3 to 5 pages of writing. I'm not going to be a stickler on the 3-page minimum like I usually am for assignments, and it's just because I don't believe that number 8 really justifies 3 pages or more. It's kind of meant to be a page to 2 pages worth, but I hesitate to say that because some of you will take that as I just write a paragraph and that's all he needs for this particular problem. I would default, or I would err on the side of getting closer to a few pages, 2 pages, okay, on the assignment this week, worth of writing about exchange traded funds and researching about the Vanguard ETF that's closest to a SPDR, okay? And I know none of that might make sense to those of you who haven't read about ETFs yet, but maybe after you've read the chapter or learned a little bit about ETFs and re-listen to this and just know that we need to cover all the material it's asking for and have some good research included in your paper, but perhaps a 2-page minimum is acceptable for full credit this week instead of a full 3 pages, okay? So many of you write 2 pages when it asks for 3 pages anyway. This week you'll just be excited to learn that you get full credit instead of getting docked. Normally when it says 3 to 5 pages, I do want at least 3 full pages of writing, and that's not including the title page or the reference page, right? So this week we'll make a slight exception to that because the material is not as extensive for this particular question, and we'll give you full credit even if you're a 2-page paper, okay? 2 pages of writing, of course. Any questions about this week's assignment? I know it's kind of a confusing instruction for the assignment if you haven't read about ETFs or if you haven't read it yet, but just keep what we've talked about in mind, and then when you read the question after you've read the chapter, you'll be in good shape, okay? Questions, Michelle, beyond that on the assignment? All right. Okay, so this week's chapters, Chapter 12 is about investing in stocks and bonds. Chapter 13 is about investing in mutual funds and ETFs. And so hopefully we'll get through all of Chapter 12. I'll be going through slides fairly quickly. These slides are really built for a full hour to an hour and a half session each. So we're going to be zipping through them pretty good. I might even skip a few in their entirety so that we can get to some of the slides from Chapter 13 before we wrap up tonight and answer any questions that you have about either one of the chapters generally before we get to spending 10 or minutes or so on the test, okay? So that's kind of what we have on the planned out for tonight. The discussion board this week is addressing the risk return question, meaning what does it mean when it comes to investing to have a risk return trade-off? What is that? And then it has some follow-up questions as well. The risk return trade-off is one of the most important concepts when it comes to investing. So even if you got out of this course with nothing more than a really good understanding or at least a good internalization of this risk return trade-off concept, this would be a highly successful class for you for the rest of your life, to take that information, to take that understanding with you. So you use the discussion board as an opportunity to really learn, like I say, a very important life concept when it comes to investing. I think you'll find that it's very, very helpful and just good information. So that's this week's discussion board. All right, so let's go through Chapter 12 and Chapter 13. Get to the slides here. So as I mentioned, Chapter 12 is about investing in stocks and bonds. And before we even start with the chapter, let me just give you a little bit of background. I think we talked a little bit about this in the last mod, so this might be somewhat of a review for many of you who studied. But stocks, when we talk about stocks, we're talking about equity ownership in a company, right? So yes, Michelle. So if I invest in Walmart stock, I'm investing in a very small partial interest in Walmart, right? Doesn't give me any power necessarily unless I own hundreds of thousands of shares, but I still am a part owner in Walmart if I own Walmart stock. Bonds don't give you any ownership. They're just the debt of a company. So if I own a bond for Walmart, Walmart is going to pay me back with interest over time. So that's a bond, okay? And both are very common when it comes to investing When we start talking about exchange traded funds or ETFs and mutual funds, we're going to be talking about packaging stocks and or bonds within a pool to create a mutual fund or to create an exchange traded fund. Okay, but these are kind of the building blocks or cornerstones of all the other products when it comes to investing stocks and bonds. Okay, so I just switched screens. Michelle, can you do a check for me and make sure that you can see learning goals now at this point? Okay, good. All right, so we know that there are all kinds of risks of investing, and this is something that would be helpful to integrate into your discussion board conversation this week. But we talked about it last mod, so I'm not gonna cover a lot of this. But basically, you have business risk, which is the risk of doing business, right? So if Apple's in the business of selling iPhones and iPads and iPods, business risk to them would be that people don't want to buy their products at some point and they go out of business. So that's a business risk. There's financial risk, them making poor financial decisions or not having access to capital. In the oil and gas industry right now, many of those businesses don't have access to financing anymore because banks are unwilling to invest, or in this case, lend money to the oil and gas industry because of how bad the oil and gas industry is right now. Well, because of that, you've got a lot of oil and gas, especially smaller companies, going out of business because at any given point, companies need access to bank financing. If they can't get it, that can put them out of business, and that's a definite financial risk. Okay, so there's business risk of operations, financing risk, or what we'd call financial risk. There's market risk, the market moving up and down as markets do. There's purchasing power risk, or in other words, the devaluation of our purchasing power, or in other words, inflation. Right? What does inflation mean? It means that we can't purchase as much as we could yesterday, as if commodities inflate, or if the price of goods and services that we buy inflate over time or go up over time. That's inflation, right? And that means we have less purchasing power over time. Our same dollar buys us less today than it did yesterday. And that concept is inflation or purchasing power risk. So a risk to me putting $100 under my mattress is that 30 years from now, when I find it or when I take it back out, it's not going to be worth hardly anything. $100 30 years from now might buy me a soda. Okay, and you might say that's crazy. $100 is going to buy more than that. But if you talk to your parents or grandparents about what they could buy with their money 50 years ago, you won't laugh. I mean, it's serious. Inflation is always eroding our purchasing power, right? And so it's a significant risk to everything we do with cash because we're losing purchasing power over time. We've got interest rate risk, the risk of interest rates going up or down and how that impacts our investments. We've got liquidity risk, the ability to get at our cash. And we've got event-driven risk, which can be anything from a terrorist event to a hurricane. Okay, so there's all kinds of different risks that can come into play when we're investing. So as far as returns on investing, we've got some basic return concepts. So we've got current income, which is like interest or stock dividends or rent on a piece of real estate. We've got capital gains, which is the increase in value over time. So if I bought a stock today for $10 and then tomorrow it's worth $12, that was $2 of capital gains, right? My stock went from $10 to $12. That's $2 of capital gains. Then you've got interest on interest or compounding interest, which happens when you leave your investments to reinvest in themselves. So you take dividends or interest and you reinvest back in your investment. So you either buy more bonds with the interest from your bond, or you buy more stocks with the dividend from your stock. And therein you accomplish this compounding interest concept or compounding investment, which means that your investment grows on itself. So if I have a CD that's at 5% and I put $100 in that CD, I'm going to get paid $5 a year. If I leave the $5 in the account, the next year I'm going to get more than $5 in interest, even though it's still 5% because I got more money, right? That's the compounding interest concept, and that's how you grow your money the very fastest is if you leave your interest or your dividends from your investments inside the account to grow on itself. Okay. This is just a chart example of compounding interest versus simple interest. Simple interest is where you take out the interest and don't get paid on your interest. And then compounding interest is where you leave it in and it compounds over time and grows on itself. The difference between the two over 20 years is substantial, as you can see by the chart. Difference of, basically almost double between the two, okay, over a 20-year period of time. So what is the risk-return trade-off? This goes right down the alley of what we're learning about this week or discussing on the discussion board. The bottom line is if you want a greater return, you have to take, in most cases, greater risk, right? Pretty straightforward. So risk and expected return are directly correlated. More risk equals more return, less risk equals less return. Now, one little caveat to this, or one little exception to this that I think is very, very important to cover, and that is if somebody comes to you and offers you a very high rate of return, and you in turn say to yourself, okay, this must be taking a lot of risk, but I'm okay with a lot of risk, I'd still like to get that return. Okay, so that's what you've thought through in your head. The exception to this that I would say is very important to consider is that the risk-return trade-off, let me just draw a little chart here. And this is me drawing on the board, so this sometimes doesn't go so well because I can't draw it perfectly. Okay, so if this is return, okay, this is your return that you're going to get. And down here, there are two R's, so I'm going to put RI. That's your risk. Very difficult to draw with a mouse. Okay, so risk along the bottom, return along the side. Okay. Look, to be directly correlated, right, you get, as I go up and take more, or I go over, excuse me, and take more risk, I'm getting more return, right? I get higher on the return scale. But then something happens way out here on risk. I take a lot of risk and I don't get paid more return. And in fact, at the very end of the curve, it actually starts to go the other direction. What does this mean? It means that there is stupid risk. And what do I mean by stupid risk? It's risk that is not paying me something for taking additional risk. Okay? When that risk-return trade-off is broken, meaning I no longer get any more return for the risk that I take, then I'm doing something that's not smart from an investing standpoint, right? We'd all look at that chart and say, of course, we would never want to invest over here, right? Where the return goes down and yet we're taking more risk. But yet, many of the investments that I look at for people that are non-diversified, that are uneducated type portfolios and investments that are taking a lot of risk and they're not getting paid commensurate for the amount of risk that they're taking. Okay, so an efficient portfolio, what we'd refer to as an efficient investment portfolio, is one that maximizes the return that can be accomplished for a certain amount of risk. Okay, so we take a certain amount of risk, we're going to get compensated for it. It maximizes that risk return. That is an efficient portfolio. An inefficient portfolio means that we're taking more risk than we should for the return that we're getting. Okay, so that is the risk-return trade-off. And now you know. And that's graphically what the risk-return trade-off looks like as well. Okay, any questions about that? So if I invest in a portfolio that's efficient and I get 8% return over the next 10 years and I'm taking, considerable risk, that might be considered an efficient portfolio. If I invest in my brother, sister's, mother's, dog's business, okay, and I'm taking a lot of risk, that may be very inefficient. I may have the potential to do well, but I also may have a strong probability of failure, okay, with certain investments. And therefore, I'm not getting paid back a substantial return for the amount of risk that I'm taking. And I should always very seriously consider not doing those types of investments that might end up leaving me with nothing for the amount of risk that I'm taking. Okay, pretty straightforward. It's just harder when you're actually evaluating a potential opportunity to think in those terms. Okay, so here's graphically what it looks like in different types of investments. Bonds towards the left side, which it means that they have less risk and less return. Top right, commodities like oil and gas, precious metals, futures, options, those things that we consider a little bit more aggressive and have potentially a higher, potential for return as well. And there are exceptions all the way up and down this chart. There are bonds that pay more than some real estate, and there are precious metals that pay less than some bonds. Okay, but this is just generally speaking. sometimes it's very important to look at this because people look at this and say, hey, I always thought real estate and precious metals like gold and silver were actually more conservative than stocks. And if you look at a 50-year chart of precious metals and you look back to the late 70s or early 80s in gold and silver, you would then say, okay, maybe not. You know, there's significant fluctuation in your gold and silver pricing back then. And if you would have invested in gold 2 years ago, you'd have been at nearly $2,000 an ounce, and now you're at about $1,200 an ounce. So you've almost got cut in half as far as your gold price in the past year. So there can be significant volatility in precious metals, commodities, and real estate, just depending on where you are in the cycle. As there can be significant, standard deviation or risk in stocks, of course, as well. U.S. Treasuries and short-term Treasury notes, not so much as far as risk is concerned, but also not so much as far as return is concerned. Any questions on this chart? A few years ago, and we're talking 6 years ago, 7 years ago, back in 2005, 2006, and 2007, there was a lot of advertising about how real estate had no risk. And then anybody who had real estate in 2008 and 2009 now is very, very clear on the fact that real estate can have significant risks. Okay, it just depends. Most of the time, real estate is levered. Okay, meaning that most of the time people use debt to get into real estate. If you use debt to get into real estate and then the real estate market goes down, you stand a very good chance of losing that property or being pushed out of your investments. And that's just one of those risks associated with real estate. Okay, something to keep in mind anyway. All right. So what makes a good investment? What's a good investment from a bad investment? Basically, the difference is what does the actual return look like? Okay, what is the return that I'm going to get? A good investment is going to give me the return that I'm trying to accomplish, and it's not necessarily higher or lower. Okay, it just is at or above my desired rate of return. If I have a desired rate of return of 3% and I'm accomplishing 4% a year in an efficient portfolio that doesn't take very much risk, that would be a very good investment for me. If I'm trying to get 8% and I'm getting 3%, that's a bad investment for me. But it might be the exact same investment that's good for someone else, right? So it really depends on our perspective and the desired rate of return associated with our investments. That's what determines whether it's good or bad, not what the return is, okay, necessarily as far as the exact percentage. Okay. Don't need to worry about that. Investing in common stock, we've already talked about it. It reflects equity ownership. And one of the things that you'll see on the test this week is that stock ownership represents residual ownership. Okay, residual ownership. Why? Because if a company goes out of business, the stockholders usually are the first to get zero. Okay, so GM gets bailed out a few years ago. GM is still in business, right? But the stockholders went to zero. Delta Airlines has gone bankrupt a few different times in their history, and every time they go bankrupt, the stockholders get zero. Okay, their stock investment goes to zero, even though the company is still there, and that's why we refer to it as a residual benefit. Why? Because the firm's debt holders and other obligations will all be paid before you ever get anything as a stockholder. Okay, so that's why it's more risky to invest in stocks than it is in bonds, because bondholders get paid before stockholders if a company liquidates. Okay? Just something to keep in mind. Some stock market charts. I'm not worried about looking at that. You've got voting rights as a stockholder. You can vote on mergers and acquisitions. You can vote on the board of directors. You've got taxation that occurs when you grow your money from stocks. Let's look at this slide for just a second, because PE ratio, and then we'll get on to chapter 13. PE ratio is the price to earnings ratio. Basically, it takes the stock price and it divides by the earnings per share. Okay, so earnings per share is important because stocks have a certain amount of volume, and think about it in terms of a pie. Okay, so your standard size pie has about 8 pieces, let's just say, and think of like a Village Inn pie, or your favorite pie, right? Just a normal size pie. Okay, if you were to say that pie had 100 pieces, each one of those pieces would be just a minuscule little sliver, right? Because it's the same size overall, but if you had 100 slices instead of 8, those would be really tiny slices. If you had 2 slices, they'd be really big, right? Each one of them would be worth more. Well, in the world of stock investing, each company is like a pie, okay? And if they have a lot of shares, if they had a lot of stock shares, those stock shares might not be worth very much, okay? So think of a company like, let's see here, what's a good one? The radio station, what's the radio that comes in? Sirius XM radio. I can't believe I couldn't think of that. So Sirius XM radio has millions of shares, okay, but they've got a pretty small pie, meaning the company's not worth very much. Because the pie is not very big and they've got millions of shares, each one of their shares is a low value, okay? And then think of a company like Berkshire Hathaway, which is a huge company owned by Warren Buffett that owns companies like Heinz. They own companies like R.C. Willey. If you're familiar with R.C. Willey, they own companies like See's Candy. They own companies like Geico. They own all kinds of companies, right? Berkshire Hathaway. And Berkshire Hathaway is a huge pie because it's worth so much, right? And on top of that, there's not very many slices. There aren't very many shares. So each one of the shares is worth a lot. So the size of the pie matters. That would, in the case of stocks, that would be how much the company's worth. Okay, that matters, obviously. But also, and very importantly, the number of shares or the number of slices in our pie example matters very importantly. The more shares that you have and the smaller your pie, okay, the smaller each one of the values of each one of your shares are going to be. The bigger the pie and the fewer the shares, the more valuable that your pie is going to be. Okay, so how does this all relate to PE ratio? Well, when you're looking at PE ratio, that's how it's an easy way for investors to look at a PE ratio and determine whether or not the stock price is expensive or cheap. Okay, expensive or cheap. If a stock price is expensive, that means that investors are willing to price that stock up because they think that it's going to grow very quickly in the future. If the PE ratio is a low number, that reflects the fact that investors think that company is not going to grow very quickly in the future and is not worth as much as far as pricing up the share price. Okay, so PE ratio is a quick way for us to look at a stock and determine whether or not it's expensive or cheap. Okay, why do I say this? Because a lot of people look at a share price, the price of each stock share, and they think that means that it's expensive or cheap. So for example, if I buy Amazon today at $500 a share, I might think that that's very, very expensive. And if I invest in Walmart today at, like, say, $65 a share, I might think that that's very, very cheap. Okay. When in reality, if I were to look at the PE ratios of each of those, Amazon might be less expensive because of how many shares they have, okay, and how big their pie is. Remember, those are the two more important things. They may be less expensive than Walmart stock, okay? Now, I know that's kind of hard to understand because we think of things, if a pair of jeans is $5 or if a pair of jeans is $30, right? The pair of jeans that's $30 is expensive and the pair of jeans is $5 that is cheap, right? But stocks are very different. The stock price is not a reflection of whether or not the company is cheap as an investment or expensive in it as an investment. The PE ratio is a much better way to determine whether or not the shares are expensive or are cheap, okay? Okay, so that's a long conversation, but that's why the PE ratio is so important, because a lot of people just look at the share price and think that that's how you determine whether or not something's cheap or expensive, and that's just not the case when it comes to investing in stocks. All right, we didn't get to bonds. Bonds are a whole different situation, but I do want to just look at it briefly. Okay, so a bond is a fixed income security, and you can use fixed income interchangeably with bonds when you're talking about them as investments. So I can say, what fixed income investment are you planning on investing in? And I could also say, what bond are you planning on investing in? And those would be the same. Something very important to understand about investing in bonds is that interest rates and bond prices move inversely of one another, or in opposite directions of one another. So if interest rates go up, bond prices go down. If interest rates go down, bond prices go up. Okay? They go opposite of each other. Now, for the last 30 years, the trajectory of interest rates in the United States has been downward. And for the last 30 years, the trajectory of bond prices has been very good. It's been a very good market to be a bond investor over the past 30 years. If, however, we were to start a cycle over the next 30 years where interest rates go up for the next 30 years, it will be a pretty poor environment to be a bond investor, because bonds tend to go opposite of interest rates, and as interest rates go up, your bond prices will go down and you'll lose on your investments if you're in bonds. Okay, so this is something very important to understand, because if I'm a new bond investor right now and interest rates are at all-time lows and probably have no direction but up to go from here, I could do very poorly if all I invested in was bonds. Okay, it might be better for me to have a diversified portfolio of some kind and make sure that I've got my risks hedged against interest rates, because my bonds might struggle if interest rates start to go back up. Okay, all right, that's the concept I wanted to make sure that you understood on bonds. Now, that's all I want to do from chapter 12. I want to give you a quick preview on chapter 13, and then we need to get to the test, but we're running out of time. So let's get you here. Okay, mutual funds, exchange traded funds, which are ETFs, and real estate. We're not going to talk about real estate. We're not going to talk about mutual funds very much, other than just to kind of introduce them. But here you go. Exchange traded funds and mutual funds. What are they? Well, a financial services organization or financial company will receive money from shareholders, and then they'll create these packaged products of stocks, bonds, or mixes of stocks and bonds. Okay, and then people invest in those stocks and bonds in the form of mutual funds or ETFs. Now, for both mutual funds and ETFs, the idea is to diversify. It's a way that you can diversify into multiple stocks or multiple bonds instead of trying to pick the winner. Okay, you can allow a team of professional managers to pick winners and losers instead of you personally doing that. That's the beauty of a mutual fund, is you offload the management of individual stocks and bonds and the risk associated with that onto professionals. Okay, and then your risk is the risk associated with that fund and not with individual companies. Okay, so it's a way to diversify and get professional management. So why do people do mutual funds? For diversification and professional management, just like we talked about. So there's open-end and closed-ended funds. Net asset value is the price of the fund. Okay, that's the price. And then we get to exchange traded funds. Okay, and I want to point out this slide real quick because it will help with this week's assignment. Okay, so when we talk about exchange traded funds, they're very similar to mutual funds in that they're a basket, a pooled investment, right? So lots of stocks in one ETF, or lots of bonds in one ETF, or a mixture of stocks and bonds in one ETF, so that you've got diversification and potentially so that you have some professional management as well. It's just a very inexpensive way to have access to all those different positions without having to buy them individually in your account. Okay, it's also a very good way to leverage small amounts of money. If I have $100 and I want to be diversified, buying an ETF or buying a mutual fund is much more cost efficient than trying to buy little pieces of a bunch of different stocks, because with $100 I can't do that very well. Okay, so mutual funds and ETFs provide great diversification and professional management for smaller amounts of money. So some different examples of exchange traded funds. SPY is probably one of the most popular ETFs that exists, and basically all it does is follow the S&P 500 index. So it basically just follows whatever the stock market does from day to day. Now this week on your assignment, it's going to ask you to find a Vanguard fund, okay, a fund, so a Vanguard fund that is most similar to a SPDR, okay, and SPDRs, okay, cover the S&P 500. So you're going to find a Vanguard fund that is similar to a SPDR or the S&P 500 index fund, and you're going to compare and contrast the ETF SPY, okay, which is a SPDR, right, S&P 500 index, to the Vanguard fund that you find that's similar to the S&P 500 index, okay, accomplishing the same objective, but one will be a mutual fund, one will be an exchange traded fund, okay. So you're going to be comparing and contrasting with this week's assignment SPY, which is a SPDR, to a Vanguard fund that is trying to do the same thing, follow what the S&P 500 does. And I'll give you a hint, it'll be called an S&P 500 index fund, okay? That's what you're looking for within Vanguard. That'll give you a hint or a tip on how to find that. Okay, that's probably all we can cover on chapter 13. Sorry, that was undercovered by far, but there's just not enough time in the evening to accomplish all of it. We need to get to the test and make sure that you have a good idea of what will be on it. But before we do that, and don't worry if you're delaying by a little bit, but any questions about this week's assignment and what we just barely talked about? Exchange traded funds are very, very similar to mutual funds. Let me just do this. Let me say the difference. Let me explain the difference between mutual funds and exchange traded funds. They are very, very similar, okay? They're both pooled investments. They both can have professional management. They both have expenses associated with them. But the key difference between a mutual fund and an exchange traded fund is an exchange traded fund trades like a stock. A mutual fund only trades once a day at the end of the day after the stock market is closed, okay? A mutual fund only trades once a day at the end of day after market is closed, and it revalues. An exchange-traded fund trades all throughout the day just like a stock does. Okay? So that's the key difference between mutual funds and exchange-traded funds. One trades like a stock, that's ETFs. One does not, that's mutual funds, just trades once a day at the end of the day. Okay? Other than that, they are very, very similar because they're both ways for us to diversify. They're both ways for us to potentially get professional management, and they both have costs and fees associated with them, as you would expect. Okay? All right. Any questions about this week's assignment before we move on to this week's test and give you some ideas for what you need to know? Concerns, questions at this point? Right on. Okay. Tina, are you still with us? No. Oh, there she is. Welcome, Tina. Thanks for being here. Okay, here we go. Let's go through the test questions. Number one on the test, you need to understand the concept of investment returns, okay? And specifically, what are the investment returns that you expect from a stock? We've referred to them tonight. You'll recall that we talked about three different return concepts. We talked about capital gains or growth, right, in the value. We talked about interest or dividends. And we talked about compounding interest. When it comes to a stock, okay, a stock investment, we would have both growth of the investment, right, potential capital gains, growth over time with that stock, and we would have dividends. Most times dividends are paid quarterly from stocks, where a lot of times with bonds, sometimes they're paid monthly, sometimes they're paid quarterly. The most common frequency is quarterly for bonds and interest when it comes to investments, for stocks and bonds, I mean. Some of them are biannual, some of them are annual, some of them are monthly, but most of them are quarterly. Okay, number two on the test talks about the concepts of capital appreciation and current income. Okay, capital appreciation and current income. Capital appreciation is the growth of the actual value of the investment. So if my stock was $10 today and it's $12 tomorrow, that's capital appreciation. That is not, however, current income. Current income would be the dividend that I receive currently on that stock. Okay, so those are different. One of them is capital gains and capital appreciation. The other is dividend income. Okay, so make sure you can differentiate between the two and know that both of them are potential returns associated with investments, but they are different. Okay, one of them is your income, that's your dividends on a stock, and the other is your capital gains or potential for growth. Two different ways to get a return from an investment in a stock. Number 3 on the test asks you about the concept of compound interest. Okay, compound interest. So just make sure you understand the concept of compound interest. We talked about it tonight, but just make sure that you have a basic understanding of what compounding interest is. Selena's, Michelle, Tina, are either of you having any problems with the audio tonight? Okay. Sorry, Selena's, it's got to be on your end then. I don't know if you can play with your audio and maybe reconnect your speakers or test your audio or something like that, or you might just have to listen to the recording at on some other device. I apologize. Okay, number 4 on the test. Number 4 on the test is just making sure that people understand the concept of total investment return. We've already referred to this. This is kind of a repeat question of one that we've, concept that we've already covered. But you've got multiple parts to total return. Okay, right? There's different components of total return. Just make sure you know what those components are, and make sure you don't get tricked by one or the other of the components being represented as the total return. Total return is made up of multiple components, not just one. Number 5 on the test, you want to know what the book has to say about the desired rate of return. And we already referred to this tonight. We talked about what the desired rate of return is. It's pretty self-explanatory, right? It's pretty straightforward. What is your desired rate of return? Well, you just establish what you want from your investment in total return. Okay. Is it acceptable to get less than that? No. Whatever your desired rate of return, you need to at least get that or better. Okay. That's the point of investing. We need to at least get our desired rate of return or better. Number 6 on the test, once again, components of total return. Question about components of total return. What is involved as far as total return? Number 7 on the test, you want to know the concept of risk-free rate of return. What is the risk-free rate of return? Once again, pretty self-explanatory. It's the return that we can get without taking risk. But when it comes to investing, how do we determine what the risk-free rate of return is? Okay, so for number 7, you'll want to know, how do we determine a risk-free rate of return? What is the risk-free rate of return? Number 8 on the test, you'll want to know the concept of residual ownership. You'll recall we talked about that in terms of investing in stocks as a stockholder. So what is the concept of being a residual owner? We talked about it, but you'll want to know what the book has to say about being a residual owner. You'll want to know about how a yield or an interest income or dividend on an investment is affected by the price of the investment. And you'll basically want to know that if a price of investment, a bond or a stock, if it goes up, the yield on that investment, whether it be a dividend yield or an interest yield, on a bond, if the price goes up, the yield will go down. So let's say I go buy a $100 bond today and it pays me 5%. If that bond goes up to $150 a share, okay, my yield is no longer 5%. Okay? If I was getting 5% on $100, when it goes to 150, my yield might be something like 3 or 3.5%. Okay, so my yield will go down if the price of my investment goes up. So you want to keep that in mind for the test. Number 10 on the test. Number 10 on the test talks about interest payments and dividend payments. In a normal situation with investments, if you're a bondholder or stockholder, you're both receiving dividend and interest payments at the same time, right? So one doesn't receive them before the other. You both, the bondholder gets paid interest first, and then the stockholder gets paid dividends second. Okay, so you'll want to be familiar with that concept, the bondholders are the first position holders. Stockholders are residual position holders. Interest paid will put priority on the bondholders getting their interest first. And then if there's no money left, the stockholders will not get their dividend. If there is money left, which there usually is, then the stockholders will get their dividends. Okay, so just remember, bondholders are always first priority. In the case of liquidation, they're going to get paid first. And a lot of times stockholders are going to go to nothing, like we talked about. In the case of interest, they're going to get paid first. And if there's interest left over or profit left over to pay interest payments, then stockholders will get paid after the bondholders have already gotten theirs. You want to know the who has access for number 11 on the test. You want to know who has access to publicly traded stocks. Okay, can anybody trade publicly traded stocks, or is there a certain qualified group of people who can trade stocks? Okay, is it open to everyone, or is it only a qualified group that can do just publicly traded stock trading? Number 12 on the test. You want to know, for 12 and 13, they're both questions about dividends. And there are two different types of dividends that you can receive on stocks. There's a cash dividend, which is the most common. And then there's what's referred to as a stock dividend. And that's where a company basically pays their current stockholders in the form of additional shares or partial shares of the stock. So let's say I own 100 shares of Walmart. If they do a stock dividend, they might say that for every 100 shares of stock, you get another share of stock. Okay, that's the dividend. So after the dividend is released, I have 101 shares instead of the 100 that I had before. But I don't have any cash in my pocket unless I go sell the share, right? So when it comes to taxation, you'll want to know the difference between stock dividends, stock share dividends, and cash dividends. Okay, what is the tax difference? Are they both taxed as income, or is one taxed as income and the other isn't? Okay, you'll want to know how cash dividends are taxed and then how stock dividends are taxed. Okay. Number 14 on the test is a concept we talked about. I said was one of the most important concepts about bond investing. It was at the end of our discussion in chapter 12. We talked about how interest rates and bonds move differently, right? They move opposite of one another. You'll want to understand that before you get to the test. Okay, make sure you've got that noted. There are a few problems on the test. 3 or 4 problems, actually. So let's just call it 15 through 17. So 3 problems that are asking you to calculate the return percentage of an investment. So how do you calculate the return percentage of investment? You have what it will show you is either the stock price or bond price. It'll tell you what it grew to, if it did, or what it went down to, if it went down. And then it'll tell you how much interest you got or how much of a dividend you got, and it'll ask you to calculate the total return over time. Okay, so it is something that you'll want to have a calculator. None of it's really hard math, but if it were me, I'd have a calculator close. You know, you probably got one on your computers, but just something I can plug in the numbers. Okay, and if you're not familiar with how you would do that simple calculation, you can either look at the slides just to refresh yourself, or just make sure that when you're going through the book, that you know that there are going to be 3 problems about calculating the total return percentage. So you may want to, read through those sample problems before you get to the test. Number 18 on the test, you're going to want to know the concept that we talked about how if the price of an investment goes up, the current yield will go down. Okay, and we've already kind of referred to that. Number 19 on the test is just understanding the concept of equity ownership. And when we talk about equity ownership, we can use that synonymously, that term equity, we can use that synonymously or interchangeably with common stock. Okay, so common stock ownership is equity ownership in a company where you actually own part of that company, right? Albeit small. Number 20 is a really easy calculation, calculating how many shares. So it basically says a person has this many shares of a company, right, to start. Let's say it's 100, even though it's not in the example. And then the company issues a stock dividend, not a cash dividend, but a stock dividend of a certain percentage. Okay. So then what we'd be doing is we'd be taking that percentage that they declared in a stock dividend, timesing it by the original share amount that we had. And whatever that answer is, we add it to our original amount, and that's the ending amount of stock that we have after the dividend is paid. Okay, I know that sounded kind of confusing. Take your initial amount of stock on the problem for number 20, times it by the percentage dividend, stock dividend. That will give you how many shares you increase by, okay, through that stock dividend. So you add that to your original amount of shares, and that sum between the dividend, the stock dividend amount, and your original amount, that sum between those two is your new amount, okay, your new ending amount after the dividend. So that's what you're going to do in number 20. That's how you set it up, and that's how you calculate it. If that was confusing, or if I didn't explain it very well, or you can't really grasp it without seeing it, just make sure and check the textbook as far as how you would calculate a stock dividend. We're not talking about a cash dividend. We're talking about a stock dividend where they pay in shares. Okay? How would you calculate how many shares you grew by, and how many shares would you have in the end after? Okay? That's number 20. A lot easier than it sounds if you haven't seen the material yet. Once you see the material, that'll come together pretty easy, I think. We talked about the frequency, the most common frequency of stock dividends. You want to know that for number 21 on the test. Number 22 on the test is $1.50 per share. Or if you don't want to take a note that it's $1.50 per share, you can take a note that you need to understand how to calculate the book value of a stock. Okay. Number 23, I'm not going to give you the answer, but it's another very simple, straightforward calculation where it gives you three numbers, and you need to know how to put those three numbers together in order to get the book value of the company. Okay, so you will need to check that before you get to the test. How do you calculate the book value of a company? Okay, just know the formula or have it jotted down close, because number 23 will ask you how to calculate the book value. It'll give you the information. You just plug it in to your formula and calculate it. You're going to want to know how we measure stock profitability. Okay, how do we measure stock profitability? So this is something that you're going to find in chapter 12, and you're going to want to make sure that you have it jotted down before you get to the test. So what is a measure of stock profitability, okay, that we look at to measure how profitable a stock is? And number 25 on the test, we talked about price earnings, PE ratio, if you'll recall. You'll recall we talked about what the PE ratio means. If it's high, that reflects the fact that it's expensive, right? And why would a stock be expensive? Because investors or stockholders think that that company is going to go up in the future, right? They're confident in that company going up in the future. If the PE ratio is low, that means that investors think that that company is not going to grow very fast in the future, and are not confident in its growth prospects. Okay, you'll want to know that for number 25 on the test. And that's it. That's the test for this week. Should be pretty good. Should be pretty straightforward. You've got an ebook for this course, which I think is a big advantage over, the Investopedia site from last mod. So if you got any questions this week, let me know. If you got any concerns as you get through the material or coursework, let me know. But have a great week, and welcome back to all three of you. I recognize all three of you from the last class. I think all three of you did very well in the last class, so congratulations. But let me know if there's anything I can do for you, and have a great week. Thanks for being here tonight. We'll talk to you later. Thank you. Have a good one.